Futures holding steady with modest advances across the three contracts, a little bit more momentum in the Dow futures contract. Well, the recent rally in long-term bond yields in the U.S. has added to economic uncertainty and rising interest rates. Of course, our next guest believes that the ongoing challenges of inflation, including a resilient labor market in the U.S., support the narrative of higher than longer rates. Let's bring in Lindsey Piegza. We're delighted to have her. She's chief economist at Stifel Financial, and she joins us right now. Lindsey, thank you so much for joining us. What is your take on this run-up in bond yields that really caught equity markets by surprise through September?
Well, it really shouldn't have caught anyone by surprise. We knew at some point investors would begin to take notice to the bloated size of the government's balance sheet being financed now at notably higher rates. Now, the Fed has been very clear in their messaging of higher for longer, but we know that investors have along the way persistently anticipated and called for a preemptive end to rate hikes and instead of pricing in rate cuts, which have failed to materialize. And it was this expectation of returning the cost of capital back down to historically accommodative levels that investors have really been able to put that worry about fiscal woes aside. But now we see that this higher for longer sentiment is here to stay. We see the U.S. Treasury ramping up quarterly issuance. And of course, this is all against the backdrop of the government's ever-growing balance sheet. And so the concern is that higher interest rates are going to make it more difficult to finance this level of debt, putting longer-term restrictions on consumption and investment as capital is diverted away to financing this level of expenditures, fiscal expenditures.
So, Lindsey, do you think that, I guess the big question is, can yields continue to stay high or move higher and the stock market move higher at the same time? I guess depending on who you speak to, some people have said that in history we've seen yields rise along with the stock market. Some have said, no, it just can't happen. That obviously as yields continue to stay elevated and perhaps even move higher, stock market will suffer for that. Well, what's your take on that?
Well, I think it's going to be more reflective of how the economy is able to fare against the backdrop of these higher rates. If, in fact, we see a meaningful reduction in domestic activity, if we see the U.S. economy slow into negative territory or fall outright into recession, the equity market is going to reflect that longer run perspective of top-line GDP. But to your point, there's nothing that says we can't see the equity market continue to rally against the backdrop of higher yields. But again, it's going to depend on the underlying trajectory of how the domestic economy responds and is able to fare in the new normal of higher interest rates.
A senior member of the U.S. Fed, this is Chicago President Alan Goolsbee, confident that the Fed can engineer a soft landing in the U.S. economy. Do you agree?
Well, the Fed is typically optimistic that they will be able to achieve that utopic soft landing, although history has shown they don't necessarily have the best track record. This time around, I think it is going to be increasingly difficult to achieve the soft landing if, in fact, the Fed keeps its resolve to reinstate price stability. The Fed still has quite a ways to go before we can talk about reinstating that 2% price target. It was never about going from 9% to 4%, but continuing on that downward trajectory. And if the Fed continues to keep rates at an elevated level in order to get that price stability component in place, it's going to be very difficult to achieve that without seeing at least a period of below potential negative growth.
Where do you think oil plays a factor in all this? Obviously, oil is starting to move higher, depending on what happens with what's going on in the Middle East. Price of oil could tick higher, perhaps reach $100 WTI a barrel, which would cause inflation to start to move higher again, especially the headline number. And I think over time will seep into the core number as well. Do you think that's going to play a factor? Will the Fed be able to separate the higher oil prices, which will cause perhaps the inflation number to rise? Will they be able to separate that out and say, no, we're just focusing on the core or super core? Or do you think the Fed will have to continue to raise rates if oil should reach those high levels?
Well, oil prices certainly are a wild card for the Fed. And to your point, right now, I think the Fed would be comfortable using that transitory language. The Fed is not going to further adjust or even adjust policy based on a temporary move in energy prices. But this backup in costs began at the early stages of the summer months. So we've been seeing this for quite some time. And the risk now is that persistently higher headline prices are going to lead or seep into, as you said, the core. And that will force the Fed's hand to take a potentially more aggressive position, again, if they keep their resolve that reinstating price stability is their ultimate goal.
What do we make of the U.S. jobs market, which once again has surged ahead of expectations? What would it take to slow down the jobs market in the U.S.?
Well, this has been one of the sizable bright spots of the U.S. economy. And again, one of the feathers in the Fed's cap to maintain this higher for longer language against the backdrop of a still tight labor market. Now, to your question, what do we need to see in order for the imbalance between labor demand and labor to supply to come back to equilibrium? Well, we would have to see either a meaningful decline in the demand for labor. And this would occur if we do see the economy slow, businesses closing their doors, closing branches. Or alternatively, businesses begin to turn to an alternative for that labor input, i.e. technology. The other scenario is a significant influx of supply. So many of these sideline workers here in the U.S. moving back into the labor market. Either one of those scenarios would help return us to a more balanced level in the labor market. But at this point, we haven't seen that to any meaningful degree. And this continues, again, to put pressure on the Fed to not only potentially raise rates again, but certainly keep rates at an elevated level for a prolonged period of time.